as well as some old sessions should all be available somewhere on YouTube or on a website or something like that. So you can always go back and watch those too. So just want to put that out there. Maybe Michael can get us that information in the chat window here shortly. But sorry, Kevin, go ahead, man.
All right. Hi, everybody. My name is Kevin. I live here locally in Kansas City. John and Mark introduced me to this group. Personally, I have owned a couple of rental property, and I managing several for my family. Personally, I have had some good and bad experience with real estate investment, and now just kind of like seeking out for some more experienced investor for mentorship and learn more about multifamily and hopefully can go in that direction.
Fantastic, Kevin. Glad you're here. And we'll try to be mentors for you, and hopefully you can help us out and take some action and move us along. So great to have you.
All right.
Cool. Isaac Wright, Unstoppable You. Nice.
Yes. Hello. I'm driving at the current moment, so might not talk as much. I'm very new to investing. I just started literally like a couple weeks ago. Purchased a multifamily last February, and I'm here to learn as much as possible.
Cool. So you purchased something last February.
Say that again?
You purchased something last February, is that right?
Yes, a duplex.
A duplex. Okay, great. No, that's great. That's fantastic. Cool. No, welcome. I love the logo. Maybe we need to change our group name to that. Just throwing that again.
It's already taken, but I appreciate
it. No worries. I appreciate that. That's a good one. I like it. So, Mr. William Carpenter.
Thank you.
How are you doing?
Yeah, doing well, sir.
I am actually out of Wichita, Kansas. I work at a CPA firm, so I deal with quite a few real estate people on the tax side, and I am currently working on buying my first multifamily. I have a 24 unit that hopefully I'm going to close on here in the next month.
Sweet. In Wichita?
Mm-hmm.
Cool. Fantastic. Are you, since you're a CPA, are you helping your customers out with tax advantage strategies and getting them to invest with you?
I'm a little leery on asking anybody that's a client to throw money at something.
Sure.
So everything that I've done has kind of been as much of a division as possible.
Yeah. No, I know a good friend out of the Dallas area. He runs I think it's a broker dealer. I don't think it's a registered investment advisor firm, but maybe it might be. But basically, he's got a lot of securities clients, things like that, and he started in real estate and just didn't want to mix the two because of the SEC regulations from that perspective and everything. And but now he's intertwined in them because he's had success in both arenas and everything. So I understand and understand where you're coming from and everything like that. So no, it's good. That's good. Congrats on the 24 unit. Yeah, hopefully that might be a good case study because you probably got that under contract after COVID struck and everything like that. So that might be an interesting one to for you to dive into with us sometime.
All right.
Cool. Vinay or Ari?
Hey,
there you are. Hey, how you doing?
I'm doing good. How are you guys? So my first day in the group. So I'm Vinay from San Jose, California, but I'm interested in the Kansas City market. So my primary focus, I want to invest in the long term between Austin, Texas, and Kansas City. So I'm doing the market research and how the market looks like, and talking to various people and networking with people in the Kansas market. So yeah, I'm looking for to invest in multifamily good deals. I'm I'll be mostly the equity partner and somebody on the boots on the ground from Kansas City to be the second partner. Yeah, let me know if you guys want to discuss further with me. Like we can have a private chat after this meeting. But nice to meeting you guys.
Oh, appreciate that. Absolutely. Absolutely. I think a lot of us are around the Kansas City area and things like that. But no, welcome from California. And yeah, I mean, we're all here to help each other out in some fashion. So
exactly. It's a team sport.
No, yeah, exactly. Appreciate that. Charlize.
Yes. Hi, everyone. How are you guys doing?
Doing well. How about yourself?
Great. Thank you guys for asking. I just stopped the video because I'm with my baby. So please forgive me next time. So I am maybe 2 years into investing. I only have single family. I'm looking forward to dabbling into the multi, just to see how that goes. I've lost a lot of money along the ways, making with my mistakes, of course, finding people to be pairs and do work, and not really knowing what I was getting into then. I've learned along the ways, and I want to continue to learn and, of course, gain some experience and give back the best I know how. And yeah, that's why I joined this group, just to kind of connect with like-minded people and continue to succeed on this path that I'm in, hopefully.
Yeah, no, absolutely. I think you bring up a good point there, where you realize at an early stage that real estate is a capital intensive game, and it's one thing to buy it, it's another thing that you need some extra cash to be able to operate it and everything. So single family, 100 unit building, whatever it is. So it's not necessarily for the faint of heart. So I applaud you for learning those lessons. I've lost money as well, and sometimes those are the best experiences that teach you. So
right.
So cool. Well, I'm glad you're here. Patrick.
Yeah, Patrick Faltico. I'm here in Kansas City also. I've been in the single family home real estate, basically just the rental market for about 10 years. Basically cashed out of what I was doing out in software in California and put my money into homes here in Kansas City back when we were in the middle of that recession, which was a great time to buy. Now I've got all this equity built up and just looking to leverage that and try to get into something bigger that just has, more cash flow. And yeah, really, I've always been interested in the multifamily. I have like one duplex, everything else are single family homes. And yeah, I thought it'd be interesting to look at the options of maybe co-investing and going for something bigger. But yeah, definitely look forward to learning from you guys.
Oh, great to have you, Patrick. That's fantastic. Last one so far, Wendell.
Yes, we're doing introductions. I just known John Wires for a long time and did some investments together. I've actually had my real estate and broker's license since 2001, and I've quite a few single family homes and multi-unit properties. I have interest in a 36-unit apartment complex, and I'm trying to build some sites to auto-analyze properties that come on the MLS. And and also just looking, right now, mostly helping other people do investments, but looking for good deals to get in on, so.
Excellent. Appreciate you being here, Wendell. Fantastic. All right, I think I've, Angel, John, and myself. Real quick, Angel.
Yes, I'm Angel. I'm the face. That's all I do. I post on Facebook.
All right, John.
Hey guys. Yeah, I know most everybody. We've been in real estate in KC for a number of years here. Obviously, just trying to keep people motivated, keep them together, look for the coveted deal, and just hopefully we could learn and grow together. And it's going to be a long journey. So I appreciate everyone coming, and definitely reach out to each other if you guys want to chat about anything.
Thanks, John. I thought this was a get rich quick program. So my fault. I'm on the wrong channel.
That's actually part of our other Facebook group, and you need special creds to get in that one.
You need $1 million, right?
At least.
We'll guarantee 12% return on paper.
Essentially. Yeah.
All right.
Yeah.
Hey everyone, I'm Greg. I've been in real estate since 2004. Done a lot of different activities around that. Built, scaled down, moved overseas, moved back to the U.S. Now scaling back up again. I met John a couple years ago. We had sushi. It was good, and that's what kind of spawned everything to date. So we've got a couple deals together. We lost one earlier this year related to COVID, so that was a bummer. But we're regrouping. We learned a lot. Stay in contact with a lot of different lenders, a lot of different investors, a lot of different people, and just looking forward to doing something with everybody. So glad you're all here and everything. With that, let me see if I can share my screen. John, are we recording? We're recording now.
Yeah.
Good. So let's see if I can go here real quick. So this is multifamily number 4 here. Everyone see that, John?
Yeah, I think so.
All right, perfect. We're just going to go into some terminology. We're going to try to move through this pretty quickly so we don't bore people. But basically wanted to get some commonality out there. So as we get into some analysis and due diligence and things like that, we had some basic understanding and familiarity. Some of these things, have sister names and that type of stuff. So, or there's slang associated with it, et cetera. So just trying to make sure that we're all on the same page moving forward with all of these things here. So again, we're not offering anything. This is just a demonstration for everything. So got a little bonus in there. I kind of came across something earlier today that kind of fell back to our last couple sessions. So I'm going to show that to you guys real quick. We can go through some finance terms and their ratios, and then debt terms and capital stack terms, which capital stack might be a term that you're not familiar with, but it's one that lenders look for, and even some investors that are highly sophisticated and done this before will want to see as well. So with that, let me see if I can navigate to what I want to see. So I was looking at something in Winston-Salem, North Carolina earlier today, and it ended up not being good because they just wanted too much money for it. But I think we kind of talked about Winston-Salem a little bit last week because it was part of the Research Triangle area and things like that. And so it just kind of, as things happen, it kind of fell on my lap here. But this is particularly the crime rate, which we've talked about a lot before and everything like that. And so you can see how the center here of Winston-Salem is obviously the worst areas to navigate through. This particular property was right off of just inside this boardwalk here in this area here, right here, Hootstown. It was just north of this interstate road, right in here on some side roads and everything like that. And what the brokers were saying was that this area in this darker blue, almost second worst dangerous, was going to get similar rents to this area right here, where there's a lot of high-end retail and everything kind of up and down this major road here, as well as some stuff that is just south here, again, in a better part of town along that major thoroughfare there. And the unit sizes were about, on average, 200 square feet less. And they were going to get a 20% premium on the rental price. And their rent comps were all from around this area, but their sale comps were from over here, up here, and that just doesn't make any sense. So when you get an operating document, you can actually, I'll bring it up real quick. An operating memorandum here. You can plug in the numbers. I tend to not plug in the numbers right off the bat because I kind of want to see where I'm looking at first, because again, location. We started on location. Yeah, I can make a spreadsheet say any numbers I want it to. That's easy to do. I can make it sing. I can make it purr. I can make it hum, et cetera, et cetera. But on this particular one, they're saying there's 144K of NOI rent growth. Fantastic. From the average rental price, they're almost $300 difference. Fantastic. Tick in a box, which we'll kind of go through next. That's fantastic, right there. So here's this apartment complex. There's all the retail. Again, that's all in a better area. Kind of coming down this way here. Property description. Yeah, so here, 574 square feet is the average square footage of a rental unit. I mean, 500 square feet is small, guys. I mean, even my one beds are mostly 600 square feet that I have in my properties. A two bed at 650 square feet. I mean, you're talking like 9 by 9 rooms for bedrooms. I mean, those are tiny. Those are really tiny 2-bedroom spaces. And then down here, so here's all the sale comps like I was talking about. Just all over. I mean, there's nothing within 5 miles of the subject. Nothing within 5 miles of the subject. And they wanted about $58,000 a door, with the average. So they wanted a premium price for a property. It was well maintained, but you're not going to get much rent bumps in the place. There's the comps for the rentals. And you can see down here that the rent price per square foot, which is a key metric that a lot of people don't talk about, understanding that in your markets is going to be huge. So it's about 99 cents average, and you're basically already at that for this Woodlawn Apartments one. So there's really no delta. The reason why this rent price is so small is because the average unit sizes for the comps are much larger. 796, 820 square feet, almost 900, almost 1,000, 800. I mean, that's a sizable difference in square footage, especially when you're going to be at home in COVID lockdown. That's a sizable difference right there. And this, again, if you read this report, I marked it up here. Here, this is the tell right here. The average rent is $300 less. And the broker thinks you can capture a modest $125. So when they start putting adverbs and modifiers and things like that from the English language in there, here's your sign. So that's just adjectives, I guess I should say as well. So that's just my perspective, just having read through. I didn't put anything in a spreadsheet. I read this, I Googled some stuff, and that's what I encountered. And basically the next 1 or 2 sessions, what I want to get to is basically a 5-minute, 10-minute back of the napkin analysis. So you can plug in some round numbers, do some simple calculations from the terms that we'll go through, all right? And you can make a determination. But this statement right here, I'll carry this statement to my grave. I mean, if I was a broker, that's gold to a fool, from my perspective. So anyway, just wanted to share that to you about location and how important that is and everything. And the devil's always in the details in anything you do moving forward. So just wanted to kind of share that. Any questions on anything with that?
No, that's a good point for sure, Greg. Like we were talking about before, when comparing the comps, they're definitely not apples to apples. There's so many amenities or utilities or square footage to take into consideration, and location in this case also. Definitely important.
Yeah, Mike or Kyle just asked here. I'll try to figure out a way to get that posted out to other people. That way they can take a look at it and everything. So it just didn't meet my criteria, basically from that.
How many units was that again?
96 or so. So it's a good. I mean, it's good size.
What is it? Was it 70s build or something?
78.
78.
So right at the lead-based paint cutoff. So. Cool. Yeah. Anybody have any other questions like that? Around that one
guys,
there?
feel free to chime in or chat about the stuff too.
Speaking of the lead-based paint stuff, like is it considerably more to rehab those older property versus those that built after the 1979? Because of you have to do the abatement and all that stuff.
It depends.
It's more of a disclosure than anything else.
Yeah.
I mean, you have to give a disclosure if it's before that certain year, not necessarily more to abate it or anything like that. Especially if you're just painting over it and not, not doing a whole lot to disturb it, so to speak. But yeah, to your point earlier, I mean, these OMs, operating memorandums, which are these sales flyers. I mean, that's the main thing you got to remember is these guys are salesmen. They're trying to sell this asset for their client, trying to get the highest amount of dollars they can for it. So they have to put it and frame it in the best light they possibly can to the potential buyer. And that's why it's just so important to go into it from an educated standpoint and know what you're getting into and know how to, what questions to ask on what assumptions they're using for their underwriting. Are the comps they're using true comps, or are they just ones that make that property look the best? I mean, it's really, you have to go into it with eyes wide open. And so those are some good points you made earlier.
No, absolutely, Mike. Absolutely. Yeah, so on the lead-based paint, Mike's talking, a lot about the operations side. And so if you, if you're leasing a property, it's one of the disclosures that you need to have them sign and things like that. And if you do anything with any type of voucher program, either local or with HUD Section 8 or anything like that, you'll have to do some stuff like that. And even if it's, I guess all my properties are older than 78, so I guess I haven't had anything that's been newer that I've rented. But I think there's a check mark on that box or something on that sheet from a operating from a rental standpoint. But yeah, Mike said around as long as you don't disturb anything, then you're fine. You go cutting through walls, you go sandblasting the old metal railings, et cetera, et cetera. That's where you're going to have to take precautions. And if you hire the right contractor, they'll advise you of that. And we'll just leave it there.
Yeah, I mean, just wear a mask, right? Solves everything.
Leave it there.
Has anyone ever actually had to do abatement for lead-based paint versus the disclosure we all are used to? I know it's not cheap or fun or easy. I
haven't. I did buy a building that had been through the Kansas City lead-free program, though, and I've got, here's the stack of papers that the owner gave me, believe it or not, about 1.25 inches thick. People can see that. You're saying that they had to, they're the ones that cleaned it out and then they got approved? Is that what you meant? Yeah. So lead safe KC program. Yeah, that sounds. Yeah, so they had a building done, and they had, some of the windows were the trim was wrapped and different. It's a brick building, so it wasn't too much, I don't think. But okay. Yeah, I mean they had a whole program done back in 2011 about it. Had to have a risk assessor out there and everything. So, but they didn't mention what the cost was, did they? Oh, it's probably it might be in there, but I don't remember off the top of my head. I'm sure it's but I can legally say I can't say that it is 100% lead free, but that it's been like lead abated or something. I can't remember exactly the term. It's a 100-year-old building, so I got to sign the form, send out the form anyway. So kind of irrelevant, but better than it was, I guess. It is. So So here's a list of terms. that I kind of just displayed them all up there at once. We can kind of briefly go through them. I'm not going to really read through them all. I want to show you some stuff in a spreadsheet as well, just to kind of give a visual of what this all kind of means underlying, and we can kind of carry it forward from there. So when you're really talking to, and some of this is more important from an investor perspective, that's the top 5-6 terms up there. The last couple are more important from your operating perspective, you as a general partner, as a manager of the business, and the lender perspective. And this is just a brief set, early stage. We could spend 8 hours just going over terminology and slang and things like that, but not right now. So the first two are probably the most important. They obviously all of these kind of cross over a lot of different industries, but from a real estate perspective, from a multifamily perspective, those are the two that probably mean the most to your investors. If they're super sophisticated, then the internal rate of return, the IRR, they'll understand how that's the a discounted future cash flow analysis, and how that is not necessarily the mechanics. Well, basically understand the mechanics of how it's calculated. That cash in the future isn't worth as much as cash now. But for cash on cash, so somebody dumps $100,000 into an investment, and the manager says, "Great, we're going to pay you $10,000 back a year." So 10,000 divided by 100,000 is 10% return. All right, so 10% cash on cash return. So what your operating agreement will say, whether or not that is a return of the principal invested or a return on the principal invested. And I can't remember who said that. I think he was an old Western guy, now that I think about it. But if anybody knows that phrase, but somebody had coined that, I'd rather have a return of my money than a return on my money. They want to get their money back. And generally speaking, that's one of the advantages of real estate, or even just partnerships in general, is that you can dictate kind of how that income comes back to you. So generally, we return investor capital. It's a return of their invested capital. And then once that is returned, then it is basically riskless for them, because they have no more money invested, but yet they can still continue to receive returns of their original investment there. Return on investment is a little bit different. It's more the net profit that the business is going to generate versus the overall cost of the investment. So cash on cash is very specific to an investor. The ROI is basically, it's a measure of the efficiency, and it along with cash on cash, ROI is used from a comparative standpoint across multiple investments. So you might have 3 different syndicators or general partners investment options in front of you. They all 3 want you to invest $100,000. All the areas are the same. Then the investors all have, or the general partners all have similar track records of success. They're all likable individuals, good management teams, et cetera, et cetera. But if one's offering, a 9% IRR or a 13% IRR and a 15% IRR and a 17% IRR, again, everything else being equal, you're probably going to take the 17% IRR. But with that, generally speaking, if there's a higher reward, there could be more risk. There's still a ratio involved with that. So again, one of the first things I talked about was the ability to tell the story. You got to tell the story about the location. You got to tell a story about the property. You got to tell a story about the investment and the investment returns. And from my experience, looking over a lot of deals, and happy to get you guys feedback as well, is that there's a sliding scale between risk and reward. Whether that's a single family house, depending on the area, depending on what you can buy it for, depending on your actual costs that you have to rehab it and what you can rent it for. versus, you know, the end reward out of it. You know, did you create a substantial amount of value so you can get that money back from a refinance or from a sale, etc. So that's kind of a breakdown of those top three there.
And from a tax perspective too, Greg, like we like the return capital evaluate, or from a tax perspective, from the CPA standpoint, we say it's a return of the capital. So, you know, there's not necessarily any tax liability there too.
Yeah, and that's really, you know, what you need to, you know, number one is how you structure the operating agreement. Number two is something you need to disclose as you bring on investors. And it doesn't have to be it's not necessarily a hard and fast rule. I mean, an operating agreement, you can write whatever you want to eat in it. What do you want to do in there? You can say you eat frogs every Friday. It doesn't matter. I mean, an operating agreement is how the business is going to operate, and the rules and procedures under kind of how it's structured and how it's supposed to operate. A partnership is whatever people agree to.
Right.
So, but it is one of those things that you need to disclose. But maybe it's a 50-50, you know, difference. Maybe it's 50-50 for the first 5 years, and then, you know, some other split afterwards or something like that. And again, you can amend the operating agreement and change it pretty much at any time. You don't need to file any paperwork. You just need to get the proper authorities to sign off on it, whether it's just the management team, whether you need a certain percentage of all the members and all the votes and things like that in the operating agreement. I mean, we could have an entire topic just on the operating agreement and whether or not you give voting rights, and to what extent do you give voting rights and things like that. So, but yes, it can be a tax efficient way for investors to distribute income. And again, this doesn't even include any type of depreciation from a macro's perspective, or from a cost segregation perspective, or from an accelerated depreciation perspective that was enabled in the 2017 tax law changes. So, you know, there's a lot of benefits to owning real estate now. There has been a lot of benefits in the past. More than likely, there's going to continue to be a lot of benefits in the future, regardless of the political environment.
And we did a interview with Yona Weiss a couple weeks ago. Definitely check out Mary, the Facebook page for that. It gives you a little breakdown of why it's so popular, essentially accelerated depreciation. And a lot of guys understand that, especially in the syndication space.
And you can do this on a single family home. Generally, it's not it's a little bit cost prohibitive, but there's some online services that, you know, you can probably, you know, $400 or $500 or something like that, you can get them to do. But basically what that does, so your straight line, your typical depreciation is the 27.5-year, 39.5-year cycle. So you basically depreciate the same amount every year until the building is depreciated. You can't depreciate land either. You have to segment out a portion for land. So you paid $120,000 for the house, 20,000 of it is land. Let's say you depreciate 100K. This is just a really quick snapshot. So that's called 1250 property. What you can do is go in and divide the actual property up into 1245 property, into its individual components. The flooring, the kitchen, the lighting, the electrical, the plumbing, the painting, the exterior, the roofs, the windows, et cetera, et cetera, et cetera. There's, you know, pretty much everything that you can put into a building, you can put into 1245 property. And this is IRS code. 1245 and the 1250 are IRS codes. You can Google search them. But they have each of those items have different depreciation schedules. So flooring, again, it's kind of based on useful life. Flooring is going to wear out, give or take 5 years. So you can put down new carpeting, put down Mark's LVP plank. I expect to get longer than 5-year wear out of that, Mark, just FYI. So you have to stay in business so we can have conversations when it doesn't work out, which I don't believe to be the case, because I had a really bad tenant move out on one. I should actually do a case study for you, Mark, now that I think about that. It had two huge dogs, and man, it held up really freaking well. But basically, it's kind of based on useful life of those individual items. So you're going to be able to depreciate, instead of like 1/27th of your building in the first year, you can depreciate, give or take 35%. And if you accelerate that depreciation from the 2017 tax law changes, you might even be able to go higher. Now, what does that mean? You carry a loss forward, is all it means. So unless you have substantial gains in other places, from other businesses or other tax returns, then it's just going to be a loss carried forward from that perspective. But that's a totally different topic. Cool. So annual rate of return is a little bit similar to the IRR, but basically it's the nominal annual rate. So if the investor got $10,000 in my example, but because they got 10% the first year, but then we increased the net operating income of the business. I'll get to that one in a little bit. But the business made more money. The multifamily apartment made more money. We were going to distribute, instead of distributing $100,000 total to all the investors, we were going to distribute $120,000 total to all the investors. Well, 10% of $120,000 is $12,000. So this investor that invested originally would get $12,000 back instead of their $10,000. So they might actually make some more money from that perspective. The equity multiple is the total amount of profit from the business plus all the equity invested divided by that equity invested. So it's basically how much money is returned by that business based on the investment made. And that's usually a whole number, I guess it is, not just a whole number, but a whole number metric. These other ones are all percentages up here. The top four are all percentages. I actually should put that in there, what the label is. But this is a whole number, and so basically, when you get to a number greater than 1, it means that you've had your investment returned. When you get to a number greater than 1, now you're making money. And what we typically like to see is somewhere closer to a 2x ratio from an equity multiple standpoint. So we can give back the investor their original amount of money and something very similar to that original amount of money as profit. That's our goal on everything.
So Greg, just for example, for cash on cash and IRRs right now, I see stuff, if people want to know what the market's bearing right now, maybe 7 to 9% IRRs in the high teens. Are you seeing something similar still?
Yeah, I think I think those metrics are kind of still the same. Personally, I guess for the investors that I've had previously, the cash on cash necessarily isn't as big of a deal as the IRR is, primarily because they didn't need the cash to live on and everything. Not that we don't distribute cash, but if it's a little bit tighter in the first couple of years, they're generally comfortable with that because they're looking to just really grow their overall investment and not necessarily receive the cash. That's not always the case though. But it's really, I guess what I've kind of found is it's really difficult to have a high cash on cash in the mid-teens as well as a high IRR. Mm-hmm. And which you think shouldn't be the case, because if you're throwing off more money, throwing off more cash on cash, that the internal rate of return would be higher. Well, a huge driver of the internal rate of return is the cash out at a sale. And I used to cash out a sale. We can 1031 it, transfer into another property, etc. But just from a pure cash out, that is a huge driver of the IRR. Even though it's 5 years in the future, it's a substantial amount of money typically, and that's a bigger driver from that. So it's as the cash on cash goes up, the IRR typically feels some weight on it, some pressure, and it's going to go down a little bit. Not at the same speed or anything like that, but they're gonna fluctuate like this, basically. So, but yeah, I mean, we want to distribute cash back to investors as best we can. You know, again, I guess if we buy a vacant property and we have to do a lot of rehab, there's no cash to distribute. So it's just what it is, initially at least. But yeah, you know, the higher single digit cash on cash, the mid teens to, you know, 20% IRR is probably where a lot of the market is now from a comparative perspective. You know, you're probably going to get more cash on cash return from and it gets all risk reward. Like I said earlier, you're probably going to get more cash on cash from a C-class apartment building than you will maybe an A-class. It's and again, that's just, you know, A-class is, you know, built within like the last 5 years. You're getting $2,000 a unit for rent. You know, there's somebody there to walk the dog. There's somebody there to give you a massage. You know, all of those. You know, they're going to lift the weights for you. Those types of amenities and everything, versus your C-class, which is your working class. You know, they pay their rent. They go to work. They pay the rent. They buy some money for food. There's, you know, congregating, you know, pre-COVID, you know, having a few beers in the afternoon, and that's life. You know, they don't really cause any problems. Their enjoyment is to go out, work, and come home at 5 o'clock, and that's it. So, and they pay their bills. So, but generally, yeah, John, there's kind of a sliding scale between those. And again, going back to the comments on the operating memorandum, so those are good baselines that the brokers will put out. The large brokerage will try to do some analysis, things like that on those types of things. But it's you got to vet it. I mean, you got to vet it hard. And we'll get to this on the debt slide here, but the amount of debt, again, risky, not risky aspect of it, and the amount of capital that you need to bring to the table to close affect those two metrics substantially. Substantially.
And just to clarify too, for the people that aren't familiar with maybe holding on to apartment buildings versus smaller residential multifamily, the reason why people like to concentrate on the IRR and the cash on cash is because, you know, you're usually force appreciating, you're value adding for a couple of years, 2 years, and then possibly selling in 5 to 7, even though it might be like a 10-year term on the debt. So that's why these are, you know, considered in the commercial multifamily space more of the main terms versus something you might hold on for 30 years, you know, real long-term stuff, and you might cash flow a tiny bit and, you know, depreciate a long ways. So just to give context as far as small residential multifamily versus commercial multifamily.
Yep. I mean, and you can run these metrics over your single families too. I mean, there's nothing special about these. These are business metrics, which is why you find them more in multifamily. You're going to find them in commercial space. You're going to find them if you're buying and selling an actual business. You go to a business brokerage who's selling, you know, the widgets warehouse down the street for Old Man River there because he wants out and the kids don't want to run the business. You know, you're going to find these same things. These are all business terms. There's nothing special to real estate about these terms whatsoever.
The ROI and the IRR, for example, they have end dates. Just FYI for people wondering. Versus
not necessarily. You usually calculate it over a period of time, but there's not necessarily an end date. So I mean, ROI will tell you when something can get paid off too. So here's a good example. You go and invest $5,000 doing a unit upgrade. Okay, you're going to get $100 a month rent premium on that. Okay, you get $1,200 extra a year. Well, $5,000 divided by 1,200 is about 4.25 years. And that's if that tenant stays in that building, pays their rent on time, that entire time.
Right.
You have no leakage of revenue. So that's a 4-year payback, a 4-year ROI. If you went into pretty much any CEO's office of any company outside the real estate world, and you in your business unit, proposed a 4-year ROI on something, it's almost dead man walking. Like, that's just way too long of a payback for a lot of things in the business world. But the way that, and I don't even have cap rate on here, but the way that multifamily and real estate at large, at least the bigger operations, are valued, they're valued on a multiplier, which is the cap rate, the capitalization rate, which is, probably should have put that one on here, but I don't necessarily believe that that's a big driver, but a lot of people do. I'm not saying it's not important. It's not good. That is good. I mean, you need to know about it. The appraiser is going to put a cap rate on there. The lender is going to look at that, et cetera, et cetera. So I'm not saying it's not important, but it's not a key metric that I look at.
And would you say it's the most overemphasized?
It is, because I think it's the most unknown. So anyone can explain it and just say that's just what the market is. Seriously, but you can. I mean, you trying to tell the internal rate of return. I mean, I remember when I had to put this together a few months ago because we did something similar for a different group. I mean, it's tough to explain internal rate of return. I mean, discounted future cash flow. I mean, discounted future cash flow. There's three terms there that you're trying to combine into one. And yeah, it's based over time. So, I mean, the IRR of the same amount of capital returned over a 5-year period and a 10-year period is going to be different, substantially. So, we're running a little bit over, and I was supposed to get off at 7 here. So equity multiple there. Overall return is basically just how much did you actually make over that from a nominal perspective. I'll try to yell over my kids here. Not taking into account anything on inflation or anything like that. You got $10,000 year over year over year over year over year, and you got a lump sum payout of something. What's that total return amount, etc. So those are all the return metrics. Usually in a percentage perspective, except for the equity multiple, that's a whole number X perspective. Expense ratio and net operating income. So those two are really guidelines or used as guidelines in terms of how you value the business and how you actually look at the business. So expense ratio is all the expenses that it takes to run the business. Right? We're not talking about your capital improvement program. You're talking about the property taxes, the insurance, any utilities you pay, the pest control, the trash, property manager, employee fees, et cetera, et cetera. All of that information or all of that data divided by the total income of the property. I kind of saying here it's generally 50-ish% or so. That's a good average. You're going to see a self-managed property get down into the 30s. You're going to see a really which again, okay, that's great, 30% expense ratio until again, going back to the OMs, they don't, the brokers won't put property manager as an expense line item out there, $0. They're just going to not include it. So unless you have a detailed spreadsheet and analysis program that makes you put something in there, you're going to miss over it. You're going to go to closing and you're going to be like, all right, hopefully the tenants have a phone number to call because I'm not managing this thing. So unless you want to. But it's those types of things you just really got to look out for and everything. So I love expense ratios in the 70s. I just see green. That's in green dollars and money. So that's really good. 10% of expenses from somewhere, and have a profit. So and then net operating income is really that entire all the revenue coming in minus all of the expenses. So then basically the opposite of the expense ratio is your operating income ratio. So if the expense ratio is 52%, the business is operating at a 48% level. And then that income is what is used to pay the mortgage, pay the debt on the property, fund your capital improvements if you didn't raise money for it, as well as pay out investors from that, any fees and asset management fees and things like that. So those are really the two big things from a profit and loss statement perspective, those types of things. So any questions on the rest of that? I'll get through my debt stuff here in a little bit. We lose John? Fantastic. We still recording?
No, I think it's working, right? It blipped for a second, but it says it's recording on my end.
It's recording.
Is it? Okay, yeah, there it is. Yeah. I see it up there. Okay.
It
Cool.
says it's recording.
Cool. Anything else on that one?
Nope.
All right, great. We'll go through debt and capital stack. So most of you guys know what debt, mortgage debt, things like that. So capital stack is basically totaling all your sources and uses, which is another term for it. And so how much money do you really need to pay for everything? What are you going to use it for? And then how are you going to obtain it, basically? So those numbers don't equal up exactly right there. I'm not sure why, because I pulled this from an old slide I had. But basically, down payment, probably most of you guys are familiar with that. How much are you going to bring to the table? I wish they did FHA loans on a multifamily deal, but generally you're going to have to put down some decent capital. That's investor capital. What a component of the investor capital is used for, $433,000 of that investor capital is used as a down payment. Investor capital comprises multiple things. Obviously, down payment, your capital improvement plan, what you want to do to the property, upgrade the units, do some landscaping, rebranding, etc. You still have acquisition costs, closing costs, whatever you want to call it. You have to prepay insurance. You have to, depending on where you're at, you might have to pay for some property taxes, depending on the time of year that you close, or you'll get a credit at closing for those. But the lender also might want you to escrow some stuff. So you got to have that cash available to pay. We had to pay for insurance before we closed. We had to have that proof in a couple days ahead of time and things like that. And so, and then you need working capital. So I think Charlize, mentioned, lost money, I've lost money, et cetera, et cetera. So, you need to have some funds available in order to just sustain operations for some time. You're going to run into a sewer line that is going to cost $20,000 to replace. You've got to have those funds available. Otherwise, you're going to have tenants call the health department, and that's not what you want. So that's kind of just a little breakdown on all of that there. Again, capital stack is sometimes used as a sources and uses program. It can be sliced and diced a little bit different way, but generally lenders are going to want some level of detail. I mean, about like this, the capital improvement plan might need to be broken down into more individual line items. Unit interiors, replacing windows, roofs, parking lot, landscaping, et cetera, et cetera. But you gotta have an understanding of how those things are broken down and how they're going to be used by the lender. And also, you need to disclose this stuff in your either in your operating agreement or in your PPM if you have more than a few people involved in your deal. So I think that's about it there, Mr. John.
Awesome. Does anybody have any questions on that? I know we could dive deep in for sure, but we always like to go over time.
I love the introductions part. That's one of the best parts, at least for me, on this stuff. Is getting to know people and learning about other people's experiences and things like that. And yeah, it takes up some time to do that, which is good.
Yeah, we may have to maybe save that for a chat window and then talk about stuff, or we could break this stuff down a little bit more. That's an option too, but
yeah, I mean, this is a high level, and part of the way that I learn and a lot of people learn is by doing. And so this is again, over the next 2-3 weeks, we want to be able to get in some deals and things like that. And, for those that are interested, even assign out, quote unquote homework, trying to find locations, trying to find properties, and getting you guys comfortable to do some quick analysis to, hey, I maybe have something here, or, no, this one's just not going to work, and you got to go through the 100 times before you find something. I mean, if you guys listen to any of the podcasts and some of the larger, people that have grown large portfolios, and I think even, Aaron and Mike, and they can attest to this, that, they've probably looked at, out of the deals that they actually had is probably, 1, 2, 3% out of everything that they look at. I mean, I get pitched, wholesale deals on my emails about 20 times a day. And I've bought 8 over the last year. Probably could have bought in 20, just didn't have the capital. But not everyone is, number one for me. Not everyone doesn't work because of location, doesn't work because of the size of it, doesn't work because of the makeup of it, et cetera, et cetera. So, there's a lot of variables as to why it wouldn't work. But now and I'm not from Kansas City originally or anything like that. I live in Lawrence, Kansas. But yet I do pretty much all my investing right now in Kansas City, on both the Kansas and Missouri side. But now I know neighborhoods, and I can look at a property. And if I'm not familiar with the street that they list on the email, and it's all single family or very small property stuff, I can Google it and say like, okay, no, this will work, or no, it won't work, et cetera, et cetera. So, that's really what you need to get to. By knowing the area, that if you dump $5,000 into a unit, you can get $125, $150 a month rent bump. Just off the bat. Just almost guaranteed, because it's tried and true, and it's proven in 6 other properties within a quarter or half mile radius.
Sure. I encourage people to definitely look back at the previous talks we did. Go over this one, because when it comes time and there's deals we're evaluating, or you're evaluating it yourself, you don't have to do such a crash course on figuring out how all this works. So just kind of make it a habit to show up weekly and go through with this stuff with us, because there's lots of information. I mean, Greg, you have a spreadsheet up there, but that's just a portion of
yeah, we can see all the different tabs. You can see all the different tabs down below here and things like that. But I meant to show this a little bit earlier, but I just reminded myself about it. Is so here's your annual rate of return. Here's your IRR. I added in a depreciation element. So when you start calculating in depreciation, what is your actual return on things? Your cash on cash return. Once you're, here's another thing is, I put in normalized here. So once you return all your money, I mean, the cash back is infinite.
Infinite.
That's a great place to be, but it's not necessarily kind of reality. So if you would have received, if your money would still be if your money would still be invested in the deal, what would your cash on cash return rate be? And again, outside of, oh gosh, what are those? They're mainly oil and gas, John, but you can buy them on the public markets. Not REITs, but
MLPs.
MLPs operate very similar to real estate, where the premise behind the MLP is it returns your capital first, but you're still invested in the deal. And that's really one of the really key things about real estate. Something as a general partner I've never understood, because if somebody's got no money invested in the deal, I understand that they should maybe get a little bit of a kickback, but maybe not the same amount of kickback. But that's just me. Because I mean, I love my investors for helping us get the deal done. I love giving them their money back. I love giving them a return of their money back and a return of what they did invest in us originally. It just didn't make profitable. It just didn't make a lot of sense for me to continue at the same rate. But that's what it is. That's kind of the industry standard. But again, you can write your operating agreement any way you want.
Yeah, I mean, there's performance hurdles, of course, and you could argue that you could get to those easier by having those hurdles because you have something to obviously shoot for. So
yeah, and that's something we haven't done, obviously, John. You know, we haven't had, you know, once it gets to 15% IRR, then it's going to, you know, then we're going to split stuff 50-50 and things like that. I like to keep things simple. And I'm not a mathematician. I understand math and I can work my way around Excel pretty well, but like, you know, at some point in time, you know, I just don't want to be doing those calculations and that type of stuff. So I'd rather just pay people more money and not having to worry about them complain or say, hey, well, you missed this expense, so the IRR was only 14.99%. I need more money. I just don't want to have those conversations. It's just not worth my time. So.
Yeah, I figured they do cutoffs or something like that, but yeah, I mean, I definitely we'll get into this stuff later. I think it's definitely important to go over terms and understand the basics, locations, property criteria, LOI stuff before you get into all these details. Because if you don't know what you're looking for, you're going to be underwriting stuff that doesn't make sense. And there's so many deals out there that you really have to understand the core and the basics before you get to nitty gritty. Because I know how much Greg loves underwriting, but we try to chat about it, filter stuff out, look over the OM to make sure, like, hey, does this check all the marks before we get into throw it in the numbers? Because once it comes to the sheet, I mean, it's game on and stuff gets crazy, and there's a lot of time invested into it. I know it's not easy. So that's why it's always important to get, I mean, some of this boring stuff out of the way, you might think, but it is definitely super important. And it's important that everybody else is on the same page too. So, people aren't just getting into things that are going to waste time. Other than that,
can I just say that I think it's important from the perspective that, Greg, I do not. And that's not my strength or what I can contribute to a partnership and a group like this. I can look at a spreadsheet and you can walk me through it, but I'm probably not going to be the best at putting my own together because that's not where I come from. That's not my knowledge base. So I think the point too is that this doesn't have to overwhelm people. Because we do have Greg and John and others who do understand this in detail, and the rest of us have other things that we can contribute that, quite frankly, maybe John and Greg don't do well. So I hope people kind of that resonates with people, that the intent here is for us all to bring our strengths into this and into a partnership, and you don't have to go away thinking, oh my gosh, I have to know all of this stuff, because you don't. We're here to help you and to learn as we go along. And, we can put a deal together and walk through it all together. And so I think that's important to note. And that's kind of the point of this group.
Absolutely.